Understanding the times. Welcome to this week's Industry Leader Update. Do you remember Blockbuster Video? That drive that you and your family may have taken to peruse shelves of video titles, which often were not even alphabetically organized. Now that could have been part of your weekend routine. But in those bygone days, the internet was generally slow, and Netflix only mailed their DVDs, having not yet begun their popular streaming service. But Blockbuster, they were slow to market a streaming service, and consequently, they were forced to close over 300 of their retail operations across the US just a few short years later. So how does one avoid the same fate? Well, in order to survive, businesses and the reverse mortgage industry must adapt to both culture and technology. It's no secret that our industry is in a state of flux. What worked yesterday most likely will not be effective today. In the mid-2000s, reverse mortgage marketing relied heavily on direct mail campaigns, which were followed by face-to-face meetings in the borrower's home. As direct mail waned and national television ads began, the shift toward call centers really began in earnest. The greatest generation from World War II preferred doing their business at the kitchen table, while younger retirees preferred a more arm's-length transaction, working with a lender over the phone or by mail. Now, while this allowed mortgage lenders to tightly control the sales process with a call center, it required substantial advertising investment. Today, the cost per funded loan has increased substantially, mostly due to fewer qualified borrowers, reduced principal limits or lending ratios, and increased restrictions when funds are used, which leads us to our present market environment. While home values have stabilized and recovered for the most part, fewer needs-based borrowers with less means are going to be qualifying. In response, many have begun to strategically reach out to builders, realtors, and financial professionals. Now, this approach has provided substantial loan volume for some, but are there more opportunities? Certainly. One potential market are mature homeowners who hold home equity lines of credit. Now, many of these individuals borrowed substantial sums after obtaining their HELOCs around 2005. But today, many of these HECM-eligible borrowers are receiving notices from their lenders informing them that they can no longer make interest-only payments, but rather must begin paying both principal and interest. Now, for those living on a fixed income, the payment shock may be unbearable. For others, it's an unattractive proposition, as many have had their remaining lines of credit either reduced or closed altogether. Now, this is just one example of where the home equity conversion mortgage can provide relief to the consumer while at the same time expanding our overall market share. Now, just as Netflix recognized and seized on market opportunity, we must do the same. Is there a shortage of potentially qualified reverse mortgage borrowers? Absolutely not, in light of our meager 2% market penetration. It's not a question of lack, but rather how one unlocks new markets, expands technology, and improves customer interaction. To prepare for the next era of reverse mortgage lending, we must first understand our times. Now, what are your thoughts? Share your comments in the comment section below, and have a great week.